do I want to do this 0 to 1 again? What's going to happen to my career, my future, my savings? It's very difficult to take up another job once you've been an entrepreneur. And I must say that starting a company as a thought was very, very difficult.
For every 1 rupee of revenue, we spend 500 rupees of expenses, etc.
When I started the company, 20% of the company's equity was reserved for employees. Sometime when you don't have a profit motive, things work out better. They cross 70-80% IRR on my overall portfolio.
Yeah.
So unbelievable.
Hi, I'm Sandeep Jethwani, the co-founder of Deserve and the host of the Create Wealth podcast. Today with me, I have Jitendra Gupta, the founder of Jupiter. In this podcast, we talk to him about his journey as a fintech founder, about how he identified the idea of Jupiter and raised capital, built a team around it. What is the constraints in the new economic environment that fintech founders should think about? How should incumbents operate in this particular space? We also go deep into his own investment journey and how he has made some of the best investment decisions after he exited from his previous company. I hope you'll enjoy this one. So Jiten, after a very successful exit from Citrus Pay, where PayU acquired Citrus Pay for about $130 million.
That's right.
Back in the day, and distinctly remember that in 2016-17, when I think the
16
when the transaction happened, this was one of the landmark transactions in its space. You could have done practically anything after that. You could have continued as a CXO at PayU. You could have created a venture capital fund. You could have worked with a venture capital fund. How did this concept of starting up all over again happen? Because you had to put yourself through that grind afresh.
Sure. So you're right. It was not easy to decide what next for me. So I worked 3 years at PayU, and I think during that time I realized that it's very difficult to take up another job once you've been an entrepreneur, and like you want to control your own destiny. You want to drive the decision making more forcefully. You want to sort of dream big rather than being constrained by what your executives feel at the board level. So after 2.5 years, I left PayU, and then there was two choices for sure, that get into the investing side or start a company. And I must say that starting a company was, I think as a thought, was very, very difficult because by that time we had 2 kids, which were young kids. And there was this whole feeling that, do I want to do this 0 to 1 again? And but then I'm like, if I have to sort of get up every day, I need something challenging. I can't be taking something easy for me. And no offense to investing, but I found that easier. So because during my PayU days, I was doing angel investing and all of that. So I felt that's a relatively easier thing, and it's not so challenging. And maybe I'm also not cut for that job. So this is how the starting up came up again.
But so was the idea coming before the concept of starting up, or the fact that you want to start up and then try to figure out which domain you want to operate in?
So I must say that the idea of starting up was first, to be frank. And once I was sure that I'm going to start, I started researching that what it should be. And I must have worked on my current idea for 6 months in terms of research, meeting the industry players, meeting the overseas players who are already into this space, meeting few investors upfront to figure out what they feel about it. I actually met like more than 5,000 consumers either through surveys or one-on-ones over a period of 3 months. I did that. Met banks, met literally so many people in the ecosystem to figure out whether there is a real business case to start in the space of Jupiter, which I started.
But Jitin, like, how did you come at that elimination, and what were like the economics around the business? Because if you think about it from a fintech perspective, you could have done let's say, direct lending to begin with, which probably would have been easier to get off the ground compared to a neobanking journey. So, walk me through the thought process of that. Like, how did you come at neobanking within fintech? I
Sure.
suspect fintech was a broad area
That's
that you
true.
said you wanted
Yeah.
to stick with,
Yeah.
but how did neobanking happen?
Sure. So I think having worked in fintech for almost 10 years and financial services for 20 years, I realized that by 2019 when I started, there's not a single fintech who actually made a real dent to any bank. And even though we operated citrus and all, we all were just chipping off something. But was there any real dent to the banking industry? I think no. In fact, if you look at the P&L of all the banks, they continued doing well on the retail side. They continued making money, or they still continue to do so. And I think when I looked into detailing that, what banks have which fintechs don't have, I think is a relationship with the customer, which is based on the deposits. And like you make decision around your payments app every day. Like today, I'm gonna use Phone Pay or Paytm or GPay. You sort of decide the point of transaction, or when it comes to lending, you figure out where are you getting the best interest rate, highest amount of your desire, and then you figure out. But your bank account, you don't change every day. Your habits are being set. People keep cribbing about the one of the leading private sector bank, but still I don't remember anyone saying that I moved out of that bank. People continue to deepen the relationship with that bank. So I'm like, this is a habit, because your investing gets set up, your EMI is getting set up. So it's very, very difficult to move out of a bank ecosystem. So I'm like, if it's a harder thing to do, but if I get into this area to start with as a relationship or as a mind share with the consumer, that this is my banking app, then it's very difficult for a consumer to think otherwise. And it's an investment. It's an investment upfront. And I'm like, anyways, my second stint, I'm taking a next 15, 20-year view, not taking a 5-year view. So first 5 year will be around investing in the relationship with the consumer, and then create a business on top of that. So it was a very, very, I think the long-term horizon is what I would say led me to start the deposit first,
Yeah.
vis-a-vis a credit first.
And the interesting part, as you were talking through this, Jitin, is that building trust with the customer is almost essential the way you are approaching it. And building trust takes time and capital.
Yeah.
Right. And then there's all this issue around a lot of upfront investment with a payoff happening much later in
yeah.
the business. And in some sense, investment management, what we are in, is also in a similar thing, right? Where the investment in building trust happens before the payoffs come, which come many years later. How did you think about the profitability, monetization concept? Because, and during the time, markets have also changed, right, in terms of fundraising and so on.
So fortunately, when we started in 2019, the funding environment is good. So and second, as I said, that this time I was very sure that I want to take a long-term view on building the business rather than a 2-year view or a 3-year view. So when I started raising money, I was like, let's raise so much money that the first couple of years we don't have to worry about proving the economics metrics, or the worrying about whether the P&L wise how we are doing, because it's a upfront investment. You need to build systems, you need to build infra, you need to build consumer trust. So we were very sure that first 2-3 years the P&L is going to be in a very, very ugly shape. So that being said, what we did was we very clearly drew out that once the customer get engaged for X period of time, how the cross sell is going to work, how the new product offtake is going to work in that base, and to what extent, and basis that my initial CAC to the LTV, and post that the whole retention cost and all of that, we factor in at a very, very variable cost economics level, and how that's going to play out. So we had done that. We discussed with our investors. The good part was when we discussed with our investors, and like I had met almost like 20 odd investors, and We had told them that this is how it's going to look like. So if you're comfortable with this, then only invest. If you're not comfortable with this 3-year, 4-year patience before we start hitting any revenue, you rather not invest. So yes, we had to, I must say, not accept money from a couple of investors who said that, oh, this is too unreal to wait for so long. And then, of course, the people who believed in the story, they ended up investing. And I must say that it's playing out that way, actually, where the first 3 years, it was not easy to make money. We have started getting revenues now after getting certain scale. So it's sort of panning out the way we thought.
And during this journey, when there's all this media about for every 1 rupee of revenue, we
Yeah.
spend 500 rupees of expenses, etc. Does that get to you? Do you react to that?
I don't. That being said, it bothers. It bothers that someone is actually showing you the truth every day. Someone is sort of analyzing your spending, your revenues, your P&L more than what you're doing. So it definitely creates, I would say, the internal pressure. But then I keep reminding myself that is it something unknown? No. It was as anticipated. It was it is as per the plan. So as far as we stick to the plan, we keep distractions out.
And when you were raising capital, given that a lot of it was required upfront, how did you think about the amount of dilution? Because a certain amount of money was required, the business was very early. So was there a framework in mind around that as well?
Yeah. So for the first round, so rather than raising the quantum of capital, I was very sure that we're comfortable diluting 25-26% when we raise the first money. So the idea was optimize as much as possible for that dilution. And this is how we could do that. For the second round, again, we said that max 12-14% and optimize as much as possible in that dilution. And similarly, in the third round, like we want to dilute 10-12% and optimize as much as raise for that. So that's the framework we took. And then sort of so on and so forth, the going forward.
So it was starting with dilution and then the capital amount was
That's
a
right.
derivative
Yeah.
of that.
Yeah.
Got it. Interesting. One of the things, Jiten, I think about a lot is every company has different phases. So if, like in case of Jupiter, there's a trust building phase and then there is a monetization phase. And that probably requires the team to shift and change during that journey also.
Yeah.
Right. How did you think about building the initial team, and later how did the team sort of evolve over a period of time? You recently have Anuj joining you to
Sure.
lead product, one of the sort of best known product leaders in the industry. So how was all of that thinking playing out at your end?
So a lot has evolved, and I think at every stage of the company you need different set of skill set who sort of augment you to create the company or build the company. I think initially I believe that from a product standpoint, the founders' vision and the involvement is the key. You got to be more involved than needed, in my view. And I think this is how, at least personally, I operated to get the product right, to iterate the product as fast as possible, after understanding the consumer preferences, choices, adoption curves. I think we explained to the team initially as well that this is how the journey would be. This is how next couple of years would play out. The reality is, howsoever you explain, team members sign up. After 1 year, they start getting jittery. Is it real? I'm not sure what's going to happen to my career, my future, my savings. And I think we saw that. We have seen, we have lived through that. So like my initial team, 80% of the team was churned within the first 12 months. Then we had to kind of rebuild the team. That 20% is still staying on, by the way. So they have spent like 4 years now in the company. That's the team which really understood and had a belief, and they're seeing the rewards. That 80% churn we rebuilt with more mindset of 0 to 1 people rather than a scaled journey people. I think that was one of the thing I would say we could have done better. Where we initially hired, we thought that it will scale. You need people with experience, so we hired people who had seen and operated scale, but not 0 to 1 ever. So we saw that we could do better there. So when we built the next set of team, we had more 0 to 1 set of builders. It helped. I think out of that team, I would say more than 60% of the team is still intact. And then now, this year, we said that now the product has got good adoption, good stickiness among consumer base. Now is the time to get the processes in place, get the more structured thinking, more structured way of operating the company. So the set of people or the leaders we are getting in are the people who are tuned to operate in that environment. So more P&L focus, more like taking decisions in terms of what's the impact of building something onto the P&L. So I think it's a very different phase of the company.
It makes sense. I love it when you said that the initial team needs to have had or seen a 0 to 1 journey.
That's right.
Because the initial journey seems very chaotic.
Yeah.
You, like as a founder, probably you know that this is expected and you're moving in that direction. But on a day-to-day basis, coming to office and figuring out ki aaj kya karna hai, and that might be hard for a lot of folks.
Yeah, that's true. And I think you want people who sort of own the problem statement and then say, I'll figure it out, rather than being told how to do it. I think that is like really, I would say, it just doesn't work. If you have to tell people how to do a particular things in 0 to 1 journey.
Correct. You know, one critical part of this whole thing, Jiten, is the whole share of equity that employees have or the team members have in the company. And there are multiple ways of incentivizing. ESOPs have been one of the biggest reasons why a lot of folks come and work with early stage companies in the journey of wealth creation. They want to be a part of that. How did you create that ESOP plan? And were there some learnings around building that also?
Sure. So what we did was, when I started the company, 20% of the company's equity was reserved for employees. And I must say that was like really a good decision, because what happens is, as a founder initially, generally the market practice I've seen is they reserve 10% odd, and very soon you exhaust, and then you're trying to dilute your investors and then requesting them, and then investors are getting involved in how much equity should be given to whom and all of that. So you kind of give away the founder control over how you're building your team. So I took this slightly aggressive approach of reserving 20% from my own equity. Now, initially when we were hiring team members, we took this call that we are not gonna pay cash salaries which are the market salaries. We are gonna pay salaries which are like 20% lower minimum. In turn, we are gonna compensate with equity. Now, what it did was, it sort of also edged out people who were chasing salary rather than company building. So that really helped. And as I said, that 20-25% of people who stayed still spending like 4 years in the company, they are of course heavily incentivized in terms of the equity. I don't think they will regret ever that when they joined, they took salary cuts, because now they're more than compensated in both now cash and equity side. So the rewards are huge.
And when you did this, how did you think about like the fundamentals, like the strike price, the vesting periods? Was there like a playbook that you worked off, or you built that afresh in terms of your own method of doing it?
We did almost give at zero price to everyone. So we said that let's say hypothetically, if I'm giving someone $200K equity, you should be in the money in that equity on day one.
Got it.
So that was the philosophy we followed, so that you don't have to worry that because initially the company is being valued at X doesn't mean the company is worth valuing X.
Sure.
So you have to create or grow into that value. So and if you tell your team members that you get only incremental from X, I feel it's not justified because they're also effectively creating X.
Correct.
So we give, until date, by the way, we do give everyone at a zero value. So whatever the last price the company has raised the money, that quantum, we value at that quantum, but the team member never have to pay any price.
Pay any price. Got it.
And we keep the vesting longer. I mean to say 4-year vesting, but the exercise is longer. So you don't have to pay any tax or worry about any tax liability.
Got it. No, I really like the fact that it is very employee or team member friendly. And I think especially as you're bringing on people in a mission of building something very large, aligning with them is very important. And this is, in a sense, the way the founder's equity is also structured, right?
Yeah.
Even in your equity, you've not paid anything to buy in. It also vests over a period of time, etc. How was the whole discussion around interacting with investors? You already had a sort of a standing, a name. I suspect a lot of investors would be inbound relative to outbound. So you said that you had a framework around the fact that people who have a long-term vision and understand the fact that initially there'll be no revenue are the people that you wanted. But on a personal level, how did you identify the partner that you will have on your board? Who are the people you will live your journey with over the next 8-10 years?
I think if you look at personally, most of the investors who are working with us, I have been knowing them personally for last 10 years. So it was kind of easier to build rapport or figure out the terms with them. And I must say, I took a safer approach by going to the known people, and because they do understand that at the end of the day, I'll figure it out. I will focus on the right fundamentals of the company. Will not be spending more than needed. This is how I operated my last company also.
Yeah.
So there was a reasonable comfort in the operating style.
Right.
Both sides, by the way, how they expect me to operate versus how I expect them to be partner in the journey.
Sure.
So it was kind of a mutual admiration which worked. And as I said, I met few investors outside of the comfort set. And then at the end of the day, I realized that I think it's not worth in the initial journey when the journey is actually tougher and longer.
Right. And is it harder to do dilution conversations or valuation conversations with people whom you're really comfortable with?
Not easy because I think the relationship takes the front seat than the objectivity sometimes. So I would say my investors also say the same way. they would say that I negotiated a lot. I do say that I left a lot of value on the table on day one. So but at the end of the day, I think both sides settled down at something where we felt comfortable and convinced. So, and I think there's no right price point, which you can say is a right price point because it's a paper company on day one.
Correct.
No value created.
Correct.
So they are placing trust in you. You are placing trust in their money and giving them trust that you'll manage their money better. So I think that's how it works.
That's a great way of looking at it. Jitendra, the investment environment has changed dramatically over the last few years. There's a lot of pressure around profitability, monetization, etc. If today a fintech founder is starting up, how would you advise them to think about this? Should they consider what is happening in the environment, or should they build as per the approach that you had, or if that is required for the business?
So it's tougher to raise money now for sure. But I would say that from an early stage standpoint, I don't think so. Things have changed. So the investors do understand that company building take time. I don't think so. Anybody expects in the first 2 years you to make ton loads of money. What has become tougher for a founder is that your first round is easier as usual, the way it used to be. It is still the same in my view. The second round has become tougher. So the approach which we took, that less sort of invest into infra, less invest into customer trust, and later we worry about economics of the business. I think that bar has become tougher to raise next round. We had the visibility back then. In today's world, I don't think so you can get that visibility. So from a founder standpoint, I think you have to cut down your cycles of iteration and have some proof points faster than what we could afford back then as a fintech founder, I would say. Second, which has become tougher, is the regulatory environment. The regulatory environment has become tougher. The regulator expects you to be compliant from day one. Earlier, there were luxuries where you could operate with lesser compliance till you are a certain scale.
Got it.
Nowadays, like regulators or your bank partners expect you to be 100% compliant on day one to be in the business. I think both things are tougher in today's scenario.
Got it. And therefore, is it even a good time to start up right now for these kind of businesses? Because if it's going to be fun, and some of the monetization might not be easy, right? It might not be fast enough for a lot of business models which have succeeded in the past. So is there a play for then fintech founders to look at something completely different rather than trying to do this?
So I would say it's easy, difficult, both. Easy in the sense there's a lesser distraction because there's a lot lesser funding happening. So you remain more focused in terms of you want to do X and how do you sort of go deeper in solving X first before you venture into something different. Because as a founder, you're always dreaming.
Yeah.
You're always dreaming about doing 5 things and getting to the scale fast. Spreading yourself faster. But with the constraints, you get best out of you in the given resources. Tougher in the sense, as I said, the iteration cycles have to be shorter, which sometimes is not easy. As I said, like if somebody wants to get into neobanking now, I would say it's very tough because of the I don't think you can shortchange the trust iteration cycle.
Right.
Building the customer service practice, building the whole trust building in the banking. The banking trust building is not about how much you spend on the marketing. It's more about how much time customer spends with you on the app and how long. The real results you start seeing after customer has been on the app for 12 months or 15 months. That's when you start seeing the results.
So the iteration cycle itself is a year plus.
Yeah. So it's very difficult to build in spaces like neobanking in today's environment unless you're a founder who has a very clear visibility to raise more money.
Sure.
But that being said, on the credit side, relatively easier to start and then you could scale as well. But again, with the recent regulation, that's also changing. So overall, I would say that the external factors are becoming tougher, but easier in terms of your focus, in terms of less distraction, of more funding happening in the ecosystem.
And therefore less competitive space.
Yeah, less competition compared to before. Like when we started neobanking company, after our funding, I had 10 more startups got funded in the next 12 months. I don't see 7 out of those 10 now. But still, at that point of view, you're like, as a founder, you're worrying, okay, this guy launched first. This guy launched a product which is looking interesting. Should you build that feature as well? So there is a in general distraction.
Yeah. Jitin, a lot of people who listen to this podcast are CXOs or senior professionals at incumbents. So people at banks and other financial services companies. How should incumbents play this thing and put yourself now on the other side
Sure.
and tell them that how they should fight an upcoming player like Jupiter?
I think the only way to, I would say, actually, there are two ways. One is the one which is more amenable to our thing, which is collaborate. It's obvious that banks and fintech should collaborate so that because banks have natural advantage of the cost of funds, the better cost in most of the products, I would say.
Yeah.
I think where they lack is the experience layer, which is where the fintech is adding value. So collaboration is a natural way. I think from a competition standpoint, I would say if they really have to compete, I think they have to carve out separate teams altogether. Like Kotak has done to a great extent.
With
Kotak 811,
yeah.
and it has been a pretty good success story. So there is something to learn out of that. Or like if you look at even SBI or SBI cards, like where SBI cards got carved out separately, and how SBI cards has been ruling the cards industry.
Sure.
So there is a scope to do that. It's all about mindset. So to develop that mindset, you carve out a separate team, build ground up, don't mix it up with the regular bank culture. Otherwise, you end up not doing justice. Like we have seen, like Freecharge was being acquired and like it's not going anywhere. So you don't want those kind of things happening.
Yeah. So it absolutely makes sense because then they are not encumbered by the bank's processes.
Yeah.
They can think more laterally and attract talent also,
That's
which thinks in that way. Jitin, I want to switch tracks now and move to your personal investment journey. Now, obviously, Citrus was a financial outcome where you had a financial surplus. At that point, how did you start thinking about deploying that capital, real estate, financial assets, private equity, venture capital? Walk us through that particular journey.
Sure. So the framework I adopted back then was, though that framework has not, I have not stuck to that framework, but at least I'll share what I thought. The framework I thought was that I'll put 70% into the public equity,
Sure,
20% into the private market, which is the angel funding and all of that, and 10% into the fixed income. That was the framework I thought. Now, when I look back, the way it has played out, it is like almost 50 to 60% into the private market, 25 odd percent into the public market, and the rest is fixed income.
Okay.
So now when I look back, I would say when I deployed the money back then, that was the best time. The valuations were more reasonable
in private markets.
In private market, the founders were more hungrier, and they were not doing it just for the sake of starting up.
Sure.
So ROI on those investments have played out really well. It has changed now, and this is where I realized two things. One, from a personal investment standpoint, it consumes a lot of time. With Jupiter, I think I'm not able to devote time to the personal investments so much anymore from last 2-3 years. So we said that this approach can't work, or not. It's not scalable.
Sure.
So we thought of creating a more structured vehicle to do the investments with a team in place and all of that. The public markets, I took a lazy approach. Invested in 2017, say, and till date I've not touched any of those investments. And whatever redemptions had to happen, they happened, but most of the investments are still intact. I would say the lazy approach really worked, where I didn't have to pay fees as well as worry about churning the portfolio and all, because when I invested, I took a more conservative that let's put in the large caps,
Sure.
Some bit of mid caps, but I'm not doing this exotic structured investments and all of that. And it just worked. Like ROI, the IRR on those are being, like when I checked recently, like 15-16%.
Yeah.
I'm happy with that.
Yeah.
I don't need 25% IRR.
Absolutely.
So that's, and fixed income, anyway, you do expect 10% IRR max.
Yeah.
9, 10. Nowadays, I don't know if it's possible. But back then, when I invested into a few instruments, they continue to give that kind of IRR. So, again, very lazy,
Right.
not done anything around that after investing. I think in hindsight, I feel there's a best approach as well. You rather take a conservative approach in investing into the large caps and the index funds and all of that, and then not worry about managing it actively.
And juicing out the last
Yeah,
penny.
and juicing out the last 1% or 2%.
Yeah, got it. And the whole private equity space or the venture capital, you were investing in multiple startups. Which are some of the ones that have broken out and done really well? And how did you identify those founders to begin with?
I would say quite a few. So I invested in 70 odd companies so far. I would say that maybe 15 or 16 companies have not worked out of that. And generally, I put the first check in most of the companies. So, but most of those companies, like 55 odd companies, I would say 35, 40 are doing really well. Now, there was only one philosophy I followed, that I invested mainly in fintech, the domain which I understand. I invested in founders who I believed could create a business here. The market size was not the problem statement, because that was a domain I understood. And I'm like, are these founders driven? Are these founders knowing the nuances of the business which they're getting into? And just ride it. Like when I look at the fintech specific, I would say 9 out of 10 have worked. I invested in a few non-fintechs as well. Again, only into the founders who I have worked with in the past, or who kind of were my clients or were my known people. So because I knew them, how they behave, operate in tough environment, easy environment, how they evaluate opportunities or how they assess the business outcomes. And so it was a reasonable amount of comfort to invest.
Right. So the interesting part, it seems like that you backed people who had a deep understanding of
the domain.
Of the domain. And secondly, you had comfort with them or were familiar with how they would behave across market cycles.
That's right.
Yeah.
Yeah. And as I said, I'm not a professional investor. So I think, and for me, it is like, it's not like I have to return capital to someone. So there is a deployment pressure. There is a certain IRR pressure. So it was more like I want to give back to the industry as well. And of course, in hindsight, sometime when you don't have a profit motive, things work out better.
Yeah.
So from a IRR standpoint, I think it's and you know a few of my investments.
Yeah.
I think they cross 70-80% IRR on my overall portfolio.
Yeah.
So unbelievable.
Yeah. No, I think it's incredible. Lots to learn from this. Thanks, Jitin, for doing this.
Sure.
And thanks for hosting us at your home so warmly. It's been a fantastic conversation.
Yeah.
Thank you so
Thanks,
much.
Sandeep.
Thank you.